Welcome to Investors Guide. You're watching ET Now. I'm Fee D'Souza. Thank you so much for joining us. On the show this week, we're going to take a really close look at the prices of gold. Now, I know a lot of you think that if the price of gold has fallen to where it is right now, which is 25,000 rupees per 10 grams, or thola, like we call it in India, it's a good time to buy gold. Well, we disagree, and we'll tell you why. That's coming up later on the show. But in the meantime, also, we continue to help young investors on this show. We'll help a young man buy his first home. We take a look at the HDFC Taxsaver fund, and we'll tell you whether you should be exiting those thematic funds right now. All right, it's time for me to bring in Kumar, the CEO of Value Research. We saw gold come down to 25,000 rupees a thola again, which is a 2-year low. And I want you to talk specifically to those of our viewers who believe that it's possibly a good time to buy gold because it's come down to those levels. We saw this happen in the past again. Do we want to advise anybody to buy gold at this point, or do we stand with our, our opinion that gold should completely stay out of everybody's portfolios?
Gold should not have been part of anybody's portfolio. If it is part of anybody's portfolio, it should not be there. And the principle or the reason or, the rationale why it should not be there in the first place is that, it's not a productive asset. The very fundamental reason, the reason why you make investment is that you want to beat inflation. You want to make your investments work harder. And gold somehow, a matter of chance or, a serious set of accidents, I would say, a coincidence, which translated into, a phenomenal run for gold 5-6 years back. And I don't think that is going to get repeated. So it's about time, people reconcile with this. Look at gold only as a consumption. If you had to buy gold, feel happy about it simply because you needed to buy gold for traditional reasons.
So the advice you're getting is very, very clear. Pull your money out of any gold ETF or any gold fund that you're holding right now. We're not hopeful. If you've lost a little bit of money, we're not hopeful that you'll regain that money from the price of gold at this point. And the very important part about jewelry, that it's a consumption, not an investment. Now, an investment by definition is when you buy something of a certain value and you sell it when the value goes up. Now, you're never going to sell jewelry if the value goes up. And I don't want you to consider jewelry as an investment at all. It's something you buy to make yourself happy or to make your family members happy. Gold is not an investment. We should stop considering it as an investment. Dhirendra, there is another entire group of people who watch this show who have very, very young children. So daughters who are no more than 5 years old, maybe 2 years old, 3 years old. And they're putting aside gold right now in lockers that will be used for weddings that will happen 20 years down the line. What's your advice for someone like that? Should they be investing in gold at this point because they want to hedge against the price from 20 years? Does that make sense at all?
I don't think anybody will have any regret whatsoever if one is not accumulating their savings in gold. That risk on a long-term basis, on a 10-year, 15-year basis, I'm confident that, any other productive asset, whether it be stocks, maybe even bonds, bonds meaning fixed income, is likely to produce superior return than gold on a long-term basis. So my sense is that you will not have any disappointment. Make a simple investment plan. Put your long-term savings into equity. It will generate substantially more return. You will be able to buy your jewelry and will be left with plenty of cash.
All right, so that absolutely makes no sense whatsoever to lock up jewelry in a locker for 20 years. We couldn't be clearer about this. That money would be better served anywhere else, whether it's a fixed deposit or a bond, or especially in an equity mutual fund. Do not buy jewelry for a 2-year-old and lock that jewelry up. Invest somewhere else. And when your 2-year-old is 25, take out that investment and buy the gold. You'll do far better, far more efficient if you went in that route. If you have questions about investing in gold, write to us. Our email ID is at the bottom of your screen. With Dhirendra, we have 24-year-old Nitish Kumar has written in. He wants to buy a car in 2 years and he wants to build a corpus of 25 lakh rupees over the next 10 years. So he has plenty of time. Income of 70,000 rupees, and he has health insurance. He has a fixed deposit that can work as his emergency fund. He also has some mutual funds, which we'll get to in a bit. But he has 72,000 rupees a year going into the LIC Jeevan Saral money back policy for a 24-year-old. And for all of the young people who are watching right now, I want to focus on this. Money back policies and whole life policies are possibly the worst investment a young person can make. Dhirendra, would you advise all of our young viewers right now to just avoid these two types of policies completely?
Yes, absolutely. One that, he has this insurance and he will be under the false impression that he has adequate insurance coverage, which while he does not have. And so that is far more disappointing. All that you need, you need to be little liberal with your estimation for the need for a term plan, for an insurance coverage, and you have to approach it directly with a term plan, nothing else. And everything else should be divided into short-term investment and long-term investment. Anything that you need in 3 to 5 years, within 5 years, should be dealt with very conservatively, should be as much into. So this is a simple, approach to be followed with your investment.
All right, so you need to stay away from endowment plans, money back plans, whole life plans. If you're a young person watching right now, just swear off all of these policies entirely. They're no good for you. It just makes sense to just avoid them. Buy a term cover for someone as young as Nitesh, and at your salary, and your salary is going to increase in the next couple of years, you should actually get something of a value of 84 lakhs, so close to 1 crore rupees, which for you should cost you no more than 7,000 rupees a year. So look at the difference from what you're paying right now from what you should be paying, and you should be investing all the rest of the money into your mutual funds. Dhirendra, these are the funds he holds: LIC India Value, ICICI Prudential Focus Blue Chip, Franklin India Balanced, L&T Mid Cap Fund, and the Motilal Oswal Most Focus Multi Cap 35 Direct, in which he has 1,000 rupees going in. I know the rest of the funds look like something he uses your advice for, but I want to focus on the Motilal Oswal Fund, Dhirendra, the Multi Cap 35 Direct. Its returns have been phenomenal over the last 1 year. It's a young fund, so it doesn't fall into that category of, something that's been around for 5 years, which is what we normally recommend. What's your review on this fund, and can more of our viewers start to use it because of the returns it has shown?
It's a relatively new fund, and just about a year and a half, and done extremely well. But I don't think, one should write it off. One should start looking at it closely. Don't get attracted to this fund based on what it has been able to deliver, 80% return in about a little more than a year. I think the reason why one should like this fund is that they spelt an approach, they spelt a strategy, they have backed it with their own money, and they are sticking to it. And we have to see that how this fund does over a full market cycle. Keep a watch. Don't jump into it all hog.
All right, Dhirendra, when you look at his entire portfolio, he's also got an investment in Axis Long-Term Equity Fund, which is a tax saver, and the L&T Gilt Investment Fund, which is invested 55,000 rupees. I'm not sure why. Could you take a look at his entire portfolio? Tell him, would you like him to make any changes at all?
Yes, I would like him to, he's young. He has all the time to benefit from investing his long-term money into equity. And right now, he seems to be getting attracted. He has invested, one-time money, or, started his SIP at different point of time. And at different point of time, he has chosen funds which did well in recent past, whenever he got started. So, and his portfolio reflects that. That's a very bad strategy. It's like looking at rear view and betting on the future. He should have a basic principle that the money which he needs for his tax saving, the maximum money which he needs to invest in to save taxes must find its way into a tax saving fund, and Axis Long-Term Equity is a great tax saving fund. And then he should not have any of the balance fund or the gilt fund or other funds. Motilal Oswal can be a significant part of, or can be a meaningful part of his long-term allocation to equity. But there he should seriously consider our aggressive growth portfolio or growth portfolio, and maybe that he can combine it with some of his own preferences. But he should get rid of the balanced fund, he should get rid of the gilt fund.
All right, so exit the balanced fund, exit the gilt fund, continue to invest in the rest of them, and of course, like Dhirendra said, switch up that insurance policy. It's no good for you. If you're a young person watching at home, you'd like us to help you, email ID is at the bottom of your screen. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. Dhirendra Kumar is still with us. It's time for us to take a look at the product this week, and we're looking at the HDFC Taxsaver Fund. This fund is 20 years old, but has its track record managed to hold up? Avan?
Thanks, Faye. We look at one of the oldest tax savers among the tax-saving funds, the HDFC Taxsaver. With an annualized return of 29% since its launch in 1996, the fund's long-term performance has been stellar. But the last couple of years have proven challenging. So how does its performance look in the recent past? Let's take a closer look at it over the last 5 years. Now you'll see that the red line, which is the fund, has not been a consistent performer in recent times. In 2012, the fund underperformed its benchmark and its category with a return of 27%. The following year, the fund's performance fell further, underperforming its category with a return of just 5%. The fund has been the worst performer in its category in the last 1 year with a return of 13%, while its category stands at 24%. But you'll see that the fund has performed better than its benchmark and its category in a 10-year horizon with a 17% return. So it's clear that the fund's performance over the long term has been better, while it hasn't done well in the short term. So should the fund's recent underperformance get you worried? Should you continue to hold on to this fund in your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those details. Dhirendra, the HDFC Taxsaver is currently at 2 stars on Value Research. The performance over the last 1 year has not been great. In fact, if you're just for the benefit of our viewers, over the last 1 year, the top performing Taxsaver funds have given returns of between 27 and 30%. This fund is somewhere around the 12% mark. So it really hasn't been impressive. Should we continue to hold it, hoping that it will bounce back like HDFC funds did last year?
This fund has been disappointing, not only last 1 year. In fact, right now, if we just look at, narrow time frame of 2000, since January of this year, it is the worst performing tax saving fund in the last 6-7 months. But I don't think that's the way to look at equity investments. And, one should not forget that this is among the oldest fund. And since its start till date, despite its worsening performance in the last, disappointing performance in the last 1 or 2, 3 years, it has still been able to generate 29% annualized return, which I would say is 3 times more than, what fixed income yields, and maybe 1.5 times more than what Sensex would have yielded. If we look at 3-year return performance of this fund in particular, and a few other funds of HDFC, they stack up well, but in between they struggle. And I think the characters are changing. Whenever it turns around, I think it has all the variables which shows in its portfolio that it is in a set of stocks which are not favored by the market right now, and other funds also don't have them in a significant scale. So whenever it does, it will turn around big time. So there's reason to be extremely hopeful, not time to give up on this fund.
All right, so that's the verdict. Hold on to the HDFC Taxsaver fund if it's in your portfolio. I know that if the 3-year lock-in has expired, you're probably tempted to pull your money out and put it somewhere else. But Dhirendra is saying, don't do that right now. Just let it be. If you're willing to hold it for the long term, it will prove its worth to you. Dhirendra, what's your verdict then in terms of a star rating for this fund?
Without giving it a benefit of doubt, assuming that this fund is unlikely to make a big comeback, still I would call it an average fund. I would give it a 3-star.
Okay, 3 stars there for the HDFC Taxsaver fund on Investor's Guide. If you have a question about this particular fund, if you're holding it, feel free to write to us. Our email ID is at the bottom of your screen. In fact, you can send us your entire portfolio, just like 30-year-old Manu Chandran has done when he's written in. He has an income of 80,000 rupees. He's been investing for the last 4 years, Dhirendra. He wants to know if he should hold on to these funds. Now, Manu has not told us what his time horizon is, which is really important if you're going to tell him whether or not to hold these funds. So, as a default version, to everybody who writes in on this show, we're going to assume, Manu, that you can hold these funds for at least 20 years, that you're looking at a long-term investment at 30 years old, which means that you should have, a long-term horizon. It does seem like a standard stack of funds. Right on top, HDFC Top 200 and the Franklin India Blue Chip. Again, Franklin India Blue Chip is a no-brainer. I know you're going to ask him to hold this fund. What about Top 200? Dhirendra, hold that one as well?
Yeah, hold that fund as well. It is in a similar situation as HDFC Taxsaver, but it's not worth giving up on this. And likewise, Franklin India Blue Chip. this fund also struggles on in between. But these are two funds which, these two funds can actually make a great foundation for any portfolio.
Well, he also has the Canhaiya Taxsaver, Dhirendra. As far as the tax savers go, this was part of your recommendation list not so long ago. Hold on to that one as well.
Yes, even now, if I have to, choose few good, tax saving fund, Canhaiya Taxsaver will figure there.
He has two more tax savers on the list. He has the HDFC Taxsaver and the long-term Access Long-Term Equity. We just talked about HDFC Taxsaver. You instructed us all to hold that fund. Access Long-Term Equity is a hold as well?
Yes, limited history, but very impressive, and doesn't seem to be getting distracted from the changing complexion of the market. So yes, it's looking very promising. Continue.
Last fund on his list is SBI Emerging Businesses, Dhirendra, and this fund had a phenomenal, run in the last 1 year. Everybody was looking at it saying, wow, this is a great fund. We should all start investing in this fund. For those viewers who, just like, Manu Chandran has invested in this fund because of the fantastic returns over the last 1 year, what should they expect going forward?
Expect, extraordinary return from this fund over a long period of time. My reasonable expectation from such a fund which states that it will be assuming risk to generate substantial return by capitalizing on, some special situation as well. And it has been able to deliver over a longer period of time. But at the same time, be aware of that, there are occasions when this fund will really falter, when this fund will look extremely disappointing, and sticking to your plan of continuing your investment will be crucial to your investment performance.
All right, and interestingly, Manu has 3,000 rupees to spare every month. He'd like to invest in a tax saver. He wants you to recommend a tax saver, but I'm looking at his portfolio. There are 3 tax savers there already. I don't see the merit in adding one more tax saver to his list. Should he just be using one of the 3 that he has?
Yes, 1 or 2 of the 3 which he has should be good enough, and I don't think there is a need to add. He already has access, long-term equity fund as well as, Canhaiya Taxsaver. He should split that money into these 2 funds equally.
All right, split the money into the funds that you already have, and if you need anything else, you can reach us. You know where we are. Then the one very quick question before I let you go. 35-year-old Abhishek Chaudhary has written in. He makes 50,000 rupees a month, and he says he has 6 lakh rupees to invest for the next 10 years. He hopes to grow it into a down payment for a home that he wants to buy. He wants to know, how should he invest this money, lump sum of SIP? The answer is already obvious. Always use an SIP. And where should he invest the money for the next 10 years? Dhirendra?
He must average his investments over the next 12 to 18 months. It's very important that he should be invested in a set of fund which does not require any maintenance. So, choosing funds from our growth portfolio, 1 or 2 funds, should be good enough.
All right, so our growth portfolio is on your screen right now. Dhirendra Singh, you can pick one of the funds that you're seeing and use them for the next 10 years. And if you need anything else, you can always write back. Dhirendra, thank you so much for joining us. It's a pleasure as always. We look forward to sitting down with you again next week. Welcome back. You're watching Investors Guide on ET. Now we've brought Feroz Aziz back in from Anand Rathi to help answer your questions. Feroz, thank you for joining us. Our first question comes in from Sandeep, who has a 10-year-old daughter. He wants to begin putting aside 40,000 rupees every month for the next 10 years for his daughter's education. What sort of investments would be ideal for an investor like him?
Since you're investing 40,000 rupees a month to just start with, I think you also can afford a financial planner who can process these applications and produce you a monthly statement giving you a synopsis of what has happened over a month, and reviews become so much more simpler if you had somebody to handhold you during this journey of 10 years to save for your daughter. Now coming to where do you invest this 40,000 rupees, let me recommend you 3 good schemes which will do justice to the money and definitely increase the probability of being able to accumulate reasonable corpuses for your daughter 10 years from now. So the first one would be JP Morgan India Equity Fund. The second one would be an ICICI Focus Blue Chip. These 2 are the large cap ones, and the mid cap one and the small cap one put together is a Sundaram Smile Fund. So these 3 funds, split your money 15, 15 and 10 irrespectively in the order which I spoke about.
Next question is from another young investor. 26-year-old Aradhana has written in. She's a first-time investor. She'd like to put aside 3,000 or 4,000 rupees a year. Aradhana, that's fantastic. I'm so glad you made that decision. That's half the battle won already. We'll give you a couple of funds that you can invest in. Feroz, could you help her out?
Aradhana, the important part is that you've also already got into you've inculcated savings as your habit, irrespective of the quantum of the saving being not very large, as you've indicated. But it's very important that in initial phases of your career, you start saving up, and then that's the prime reason why you can actually create huge amounts of wealth. These initial phases of investments actually cascade into huge maturity values. So good job in terms of saving up some monies in the initial phase. Now coming to what schemes should you buy, I would recommend you 3 of them. Birla Frontline Equity Fund, where you can put 1,200 rupees, SBI Magnum Mid Cap, where you can put 1,200 rupees again, and then you can put about 1,600 rupees in Franklin Templeton India Income Opportunities Fund, Franklin Templeton India Income Opportunities Fund. That will be a debt fund. So these are the 3 funds. If you split your money 1,200, 1,200 and 1,600, you will have almost about 50%, more than 50% in equity, and about 1/3 of it in debt.
Last question comes in from 33-year-old Vinayak, who's written in. Now, he says he'd like to start tax saving and he wants you to recommend a couple of funds that he can invest in. Additionally, he's invested a lump sum in Reliance Diversified Power Sector Fund. I know you're not happy with that right now. He wants to know what he should do with that fund. Well, the advice on this show, Vinayak, is that you should always, avoid thematic funds, whether it's a pharma fund or a banking fund or a power sector fund. Just stay away from those funds entirely. Make your own life simpler by using equity diversified funds. Don't go into any fund that focuses on a particular part of the market, because when that part of the market does badly and they take turns to do so, then your returns will come down. Instead, use an equity diversified fund that will spread itself across the entire market, so you don't particularly get hit at any point of time. But Feroz, if you were to give him an alternative, what would that be?
So rule number 1, never buy yourself a thematic fund unless you have your core portion of the portfolio well in place and is actually providing the stability. So the answer would be exit your 8,400 rupees. Don't wait for the emotional number of going back to 10,000, because that's going to take some time or might not take time. But I think the strategy has to be clear that you need to have a core portion of the portfolio. The core portion of the portfolio will have 2 categories of funds. One would be a large cap fund, one would be a mid cap fund. In the large cap category, let me recommend you an SBI blue chip fund, and in the mid cap category, look at a Franklin Prima fund, which is a very good mid cap fund, both existing for long periods of time and have consistently beaten benchmark over long periods of time. So these are the core portion of the portfolio. And then comes, if you're really interested in making life more difficult for you, that's when you get into a thematic fund.
All right, so what have we learned this week? Keep your investments simple and, of course, avoid those whole life policies and money back policies and endowment policies from insurance companies. Stay with simple investments that you can understand. It's a wrap on Investors Guide. Thank you so much for watching. Email ID is at the bottom of your screen. So is my Twitter handle. Stay in touch.